Fireside chat, we're going to demystify mortgages. We've got Lee Appleby, who is the California mortgage expert here, and we're going to go through everything right from what is a mortgage, how does it work, the different subsets, and more importantly, which one is the right one for you. So Lee, thank you so much for coming in. How are you doing?
Pleasure to be here. Thank you.
So there's so much in the world of mortgages, similar to trusts. There's so many to pick from. Can you just help us really give us the 101, break it all down so that a 5-year-old would understand it? What's good, what's bad, what's happening with the current interest rate and everything in between. So just give us some of your mortgage expertise, if you will.
So let's start like this. So there are 3 ways to qualify for a mortgage, right? The first being QM, which is considered qualified mortgage, right? Which would consist of 2 years tax returns, that being personal and business, 2 months bank statements, all pages of those statements, driver's license, that kind of documentation. That would allow you to get the best rate possible. So you have to look at it like this. Every time that you are missing something from a qualified mortgage, meaning documentation, the bank will ding you for that, right?
So it's kind of like a credit score type thing.
Well, it is. Well, credit score is a big part of getting a mortgage, right? So usually the base used to be 680. Now, the closer you are to 760, the better rate you will get. So aside from 2 years tax returns, both business and personal, there is something called a debt service loan, meaning you can buy a property, not use any documentation, and qualify based on the income of that property.
Okay, so that's like for a passive investment or something like that.
Exactly. Then there's something called a stated income verified asset loan. So you would take 12 months bank statements or 24 months bank statements in lieu of those 2 years tax returns, both business and corporate.
That's a lot, right? Like for that QM loan, it seems like there's a lot of due diligence and digging that they go through.
Well, there is, and most people in our arena aren't able to use that kind of documentation because a lot of people are now set up in a trust and everything is passed through that trust.
Okay, right? So if you're using a QM, that's more tailored for W-2 employees?
Exactly. Exactly. Or people that aren't set up with a trust the way that you set the trust up, right?
All right.
So the way it would work is we would use the bank statements from the trust.
Yep.
And we would qualify them based on those monthly deposits on the trust.
So it wouldn't be the LLC that's feeding the money into the trust. It would be the trust itself.
Exactly. Wherever the actual bank statement is what we would use to qualify them. And that would be, like I said, in lieu of those 2 years tax returns.
And how would it work if, let's say, for an example, we had one big lump sum come into the trust annually in, let's say, January or December, versus if there was a set amount coming in monthly throughout the year?
It's a good question. There is probably a handful of lenders that would allow you to qualify on that one lump sum. They want to see monthly deposits. Because what they would do normally is they would look at either your personal bank statements to look at monthly deposits, or they would look at the business deposits. So the way it would work is for business deposits, they will give you 50% of those monthly deposits towards qualifying for a loan.
So as an example, let's just contextualize it. If you've got $1 million coming in every single month in top line revenue, you could get a loan in the region of $500K.
Well, no. When you're saying when you're saying a deposit annually of $1 million?
No, I'm saying, let's just do that then.
Well, so you're looking at monthly deposits roughly of $100,000. If that were the case, if those was business deposits, they would credit you $50,000 a month towards qualifying for the loan.
Okay. So
as opposed to if it were a personal bank statement, they would give you 100% of deposits. They would give you the whole $100,000.
Got it. So if, let's say, the money was going from an LLC into a trust, and then we can just simply say, hey, this is all the money that the trust was due, you'd get 50% of that.
That is correct.
Annualized.
Or you could use the LLC bank statements, right? Because that's where the money is. You could have either or.
It's generating from,
exactly. Right. As long as we can show a pattern of deposits.
Okay.
Right.
So the pattern is key here. So it's a monthly or quarterly would be acceptable or not?
Monthly would be ideal.
Okay.
If there would be a way to set up a distribution monthly. Then that would be fantastic.
Like the member of the LLC controls that distribution. So whether that's monthly, quarterly, annually, it's up to the managing member when that distribution occurs.
Exactly. So that would be ideal.
Okay, so the managing member controls the monthly deposits, the frequency, the cadence, it's totally up to them. So we could do that on a monthly basis, no problem. Now, what would be the difference in rate or a range, as an example, between getting a qualified mortgage versus non-qualified?
Usually about 1 to 1.5% difference.
Okay.
But they also have to look at the tax savings by not having the money come personally, right? Mm-hmm. So the issue is that there's no other way to qualify other than doing a new QM loan for people that are using an LLC or a trust.
So right? Is it safe to say that most business owners don't do a QM loan?
Most business
do.
They cannot.
They can't because they're not W-2s, right?
Well, no, because they're not showing, even though they're making their 1099 money is enormous, they are writing everything off.
Yeah, and that's what most business owners do.
Well, that's what most good CPAs do, right? I mean, and I have this conversation with clients all the time. They say, Lee, I'm making $1 million a year. And I say, well, that's fantastic. You'll have no issues. And they send me over the tax returns, and they are, in fact, making $1 million a year, but literally writing off $900,000 of it. So as far as banks are concerned, you make $100,000 a year. And I have these arguments all the time, and they don't understand. Well, that's what you earn. You have written $900,000 off, right?
It makes you unbankable when you're playing those games.
Well, exactly, but it's nice that we have these options as far as new non-QM loans now, right?
It's really key because, as an example, with our clients, we make them ghosts on paper because we don't want people to be able to sue them. We want to keep them in the private world. So that means we're going to reduce the income as well because, like you said earlier, the amount of money that you're going to pay extra for that type of loan is far more in the tax savings by using a trust. Right. And you're better off paying the extra percent or 1.5% on just one asset type, which is the mortgage, and saving hundreds of thousands every single year on taxes, having the asset protection in place. So you've got to look at the full picture, not just one subset. Hey, what's the rate here versus this type of loan?
Exactly.
It's not apples to apples, as we would say. Right?
And what also is nice, I have a program available that just became available about 6-7 weeks ago, where most of these known QM loans, when we're doing bank statement program loans, they will look at 12 months bank statements, and they will look at all pages of those bank statements to see where the money is coming from. I now have a bank statement program that just uses page 1, which literally shows deposits only, so you don't have to source those funds, which also makes things a lot easier because a lot of people have accounts where they'll wire money from one account to the next. That really isn't a deposit, right? That's the transfer. But with this particular loan, they would know that that is the case, right?
Well, not that they wouldn't know, but they're not looking for that. They just want to qualify.
They just want to qualify based on the deposits, right?
No, that makes a lot of sense. And it's good to understand that because I think it's similar to trusts. There's so many different types of mortgages. So we touched on some of the others. What is the rate spread difference with the other types of mortgages compared to what we just spoke about?
Well, so as I said before, so you have a QM loan, which is the 2 years tax returns business personal. You have a bank statement loan. You have the debt service loan, which is, I'd said, based on the income of the property qualifying.
So that's mainly, the debt service loan is mainly for investment properties.
That is correct. Right? And then the last would be private money, right? Which is technically hard money or a bridge loan.
It's usually the most expensive.
It is definitely the most expensive. And also people have to realize, and this is another conversation I have all the time, when people are equity rich as far as the property is concerned, but they make no money on paper.
Yeah.
When they try to obtain a loan, they're not financeable because even though the property is worth millions of dollars, if they can't show sufficient income to repay a loan, they can't get a loan for anything on the property.
So can they not get like a home line, equity line of credit, or a reverse mortgage?
Well, a reverse mortgage, yes, they could get, but they would have to be 62 years or older to qualify for that, right? Okay, yeah. There is no income documentation on a reverse mortgage loan. But I'm saying even with private money, there is something called the ability to repay rule.
Well, yeah, that's the number one thing that most lenders are looking for is, okay, I'll give you this money, and yes, there's an asset backing it, but you've got to be able to pay that back to me. Exactly. So I don't want to go through the hassle of fighting you in court to get hold of that asset.
Exactly, because once again, these people are not in the property ownership business. They don't want it as a piece of paper to them that they want the return on investment. But the law stipulates that they have to have the ability to repay. Otherwise, they can't obtain a loan, even a private
just
money
a shark
loan.
looking to obtain properties, right?
I'm sure those are out there, of course. But I'm saying you would still have to have an exit strategy. And it is perfect if it's a short-term loan. If somebody has got a big deal closing in 6-7 months, then sure. To spend 10-11% on a private loan, that's fine. But there has to be an exit strategy,
But
right?
I actually issue private loans. I work with a family office, and I give them hard money, and we invest specifically in real estate for that type of deal.
10-12%, right?
Minimum 12, yeah.
Right.
So it's a good return for me on my funds, and really solid investment because it's backed by real estate.
Well, providing it's a first or second. I wouldn't want to be in a third or fourth position.
Yeah, it's always usually a second. But I like that. That works well for us. So we've talked about traditional loans. Then let's talk about more creative stuff, because you do a whole host of things,
well,
right?
Yeah, I mean, I predominantly work with business managers and CPAs. I mean, I come up with creative financing concepts to get these people loans that they can't obtain through a bank, right?
So what does the bank usually look for? Is it just the home runs? Hey, we've got your pay stubs coming in every 2 weeks, regular.
Well, you have to look at it. When you're dealing with a bank, there is a set of qualification that they're looking for, right? Mm-hmm. If that square peg doesn't fit, you can't obtain a loan.
So they have a very strict criteria.
Exactly.
They want to have this much in annual income. They want to see that you've got a buffer, right? So that you're not running out of money at the end of every single month, because most Americans live paycheck to paycheck.
Exactly. And I this is another conversation I have all the time. They tell me that they've been banking with these banks for 15, 20 years.
Doesn't matter though,
and they just don't care. They don't understand that they're a number. Do you understand?
Cog in a wheel.
And that's all it is. So this is the misconception, I think, that I find discussing with my clients all the time. The misconception is that the big banks offer you the best service and best rate, and it couldn't be further from the truth.
Normally the credit union on the street corner, right?
It is. They don't care. I mean, if you're dealing with a bank that will underwrite a loan in a different state than the person's in, and you have no communication with the underwriter stuff, I underwrite all my loans in-house. I'm available 7 days a week. You need to call me at Saturday at 7 o'clock. I'll answer your question. Try getting that from one of the big banks. It's not possible. And they have no answer for you because it's out of their hands. Where everything I do is in-house. It's underwritten in-house.
So that's the power of having someone working specifically with you to get that outcome.
Well, not only even that, it's working with the type of client that you work with, the entertainers, the doctors, the directors. That is my bread and butter that I've been dealing with for 25 years. That's why I have, 3 of the largest branches in California as far as business banks. Anything that this particular bank can't underwrite themselves, they call me.
So you're the fixer. You're the go-to mortgage guy.
Of course I am, yes.
That's really good. So, and again, most of our clients are similar. They are high net worth individuals. It's not the standard. We don't want them to show $500,000-$600,000 of W-2 income.
That's right.
That's a stupid amount to pay on taxes, both as the employer and employee. You're going to get crushed. So we definitely don't want that. So what are the most common things that you do for these, let's say, high net income people or high net worth people in terms of finding the best way or the most common top 2, top 3 strategies that are used right now?
Well, what I do is I make the process as simple as possible for them, right? Mm-hmm. So I do all my due diligence and work up front. So what I tell all of my clients, if they're looking to purchase a new home, the first thing that we do is get you pre-qualified. Let's take the guesswork out. Because inevitably what happens is that even if we are doing a bank statement loan, which is technically in the company name, right, or the LLC, you are personally responsible for this loan. So the first thing you do is run a credit report to see if there's any mistakes that show up, because 9 times out of 10, if somebody hasn't run a credit report in a couple of years, there's a doctor bill on there that they didn't know about. We need to fix that.
Yeah, it's doing the diagnosis, right?
Up front, of course. A lot of people go and look for property and say, look, I know I can qualify. This is it. Most realtors will not even work with a client anymore unless they're pre-qualified, right? So I take the guesswork up. I take it out at the very beginning, right? So I simplify the process. All the documentation is done up front. So all that you need to do is find the property, right?
Simple.
Right. And as
Not
far
in
as
this market, but
well,
relatively
exactly.
speaking,
But as far as rate and turn times, I mean, I'm closing loans in 15 days. You go to one of the big banks.
Wow, that's really, really
Well, I'm
quick,
saying
right?
you go to one of the big banks, they'll quote you 45, 60 days, maybe. Yeah. And then you're jumping through hoops, and you've been banking with them for 20 years.
And you're probably going to miss out on the deal because they've got better terms from other people, right?
Exactly, yeah. I mean, look, in this market, there is a lot of cash buyers out there, right? Which doesn't seem to make sense to me either, other than the fact if you can remove a loan contingency up front, then what difference does it make to the seller if you're obtaining financing or not, if that's not part of the equation, right?
So what are the common contingencies that you see, and kind of what's the usual process flow on removing them versus the way you do it?
Well, see, so normally what you would have a 17-day loan contingency, you would have an inspection contingency, right? You'd have your appraisal, right? So I'm able to underwrite loans, like I said, in 10 days. So
how can you do it so quickly?
Well, because I have my staff in office.
Okay.
So once you have the stamp of approval from me, it's done, right?
Fantastic.
So therefore you can waive that the finance contingency or the loan contingency.
And that gives the seller a lot more comfort because now they know, all right, this guy's got his money in order. That's probably the most important thing because I know the house is in good condition and they can have more peace of mind.
Exactly. But like I said, I take the guesswork away up front. I like to do all the work on the front end so that the client's life is made a lot easier, right? And as far as the financing options, I don't ever suggest that clients do interest-only loans. And for the simple reason, well, let's clarify something. If you do an interest-only loan and you take advantage in some cases of a less expensive rate, providing you double up on the payments and take advantage of the lower interest rate, then it makes sense. But
just managing your cash flow, right?
Well, yes, there's a flip side, right? Because if you are technically doing an interest-only loan and you never do make a principal reduction and you're just making an interest payment,
it's wasted money.
It's a waste of money. You're better off renting a house and saving the headaches of the upkeep of a house, right? Because home ownership is not inexpensive.
Especially here in Beverly Hills where we are, right?
And it's a fortune, right? Yeah. So unless you're going to take advantage of the lower interest rate on an interest-only loan and double up payment, I don't ever suggest a client do that.
So one of my friends, really savvy guy, he's got like a $5 million house and he did interest only. And what he said to me is, hey, I can pay a lower payment because it's just interest only. And then the money that I would have spent on my principal or on my regular mortgage payment, I'm going to go into investing and making me more money so I can use that to then pay down my principal and make a better use of my funds. And I was like, it sounds really risky to me. What would your take on something like that be?
If he actually does it, that is
He did it.
Okay. Well, then that's a different story.
He was a finance guy. He's really detailed with his numbers.
9 times out of 10, that never happens. And what happens is, whether it's a 7 or 10-year interest-only loan, 7 years down the road, they have not made a penny of principal reduction, and now it comes time to refinance that loan.
So what would be the case? So again, this was a few years back when property prices were going through the roof. The other argument he gave me was, well, my house is going to be worth, it's $5 million now. It's probably going to be worth $6 in the future.
Okay.
So even if he doesn't make a principal payment, when he comes to refinance it, it's okay because the value of the assets increased. Now, that isn't always going to be the case, especially now.
Exactly. So if he would have taken that route, that wouldn't be the case now, right? If you paid $5 million 3-4 years ago, that house is not $5 million now, even in this market, right? So there'd be a problem. Right.
So it's risky on both counts.
Yeah, look, I'm very conservative with things like that. Like I said, home ownership is very expensive. You don't want to strangle yourself to make that monthly payment every month, right? Yeah. So you buy yourself a home that you're comfortable in making that 30-year fixed payment or 15-year fixed payment, and yes, you can always pay it off whenever you want, right?
Do you have a preference on how long the term should be or what makes more sense?
Well, as I say, for a 30-year fixed note to me is always the safest, right? Yes, it's a long term. And yes, that the advantage is if, let's say, 5-6 years into a 30-year note, rates improve, which we hope will do, right?
They've got to. They've been going up
I
for a while.
can then put them in a 24-year fixed note, so they don't lose the 6 months of principal reduction they've had, right? I have the option to do that, right? Or if it's 10 years in, I can put them in a 20-year fixed, so they don't start the 30-year clock all over again, right?
Got it. Okay, so there's solutions. It doesn't always have to be 15 or 30.
Exactly.
Because most people don't really know that. No one's really explained that to me before.
But what you have something called an inverted curve right now, where adjustable rate mortgage prices are actually more expensive than 30-year fixed prices.
That makes no sense at all.
But that's just the way the market is right now. So anybody that calls me to say, what's the pricing on a 5 or 7-year fix, I'm saying the pricing on that is ridiculous.
Yeah, why would anyone do a variable rate that's higher than a fixed?
Right, makes no sense.
No.
Yeah.
And it would only make sense if the variable rate was super low.
Substantially lower, yes.
And
we're not talking about
outlook.
an 1/8 or 1/4% lower,
Yeah.
substantially low, that's right.
And then also future pacing that you don't see it coming back through the roof.
Well, yeah.
Because it's a huge risk, right?
Well, absolutely.
That's what happened in 2008 when people were getting loans with no verifications and multiple houses, and then all of a sudden it all goes to pot, right?
Yeah, no, and this is what happened. Obviously, this is what will happen with the interest-only notes as well. When you're paying 5% interest only, all of a sudden 7 years down the line, that 5% interest only now becomes 7.5% principal and interest.
So it's a big change.
Difference, right?
And we're kind of seeing something like that now, right? Whereas a few years ago, interest rates were like 2s and 3%. Now they're 6s and 7s.
Yeah, exactly.
So that same amount of cash that was outlaid for a mortgage back then is maybe doubled or at least nearly tripled now, right?
Yeah,
if you look at the money cash on cash value
absolutely,
of it.
sure.
So if you're paying, let's just say $3,000 previously, it's gone up to $8,000 to $9,000 right now.
That's exactly right. Yeah.
And most people can't afford that because they are living paycheck to
paycheck. That's right.
Which is really scary.
Yeah.
So let's kind of transition into the rates and the Fed and what you think. Again, no one has a crystal ball and we're not issuing any financial advice, but you've got your finger on the pulse. You've been around the block many decades. The Fed has just increased rates again by another 1/4%. What do you think the next 6 months or year looks like?
Well, let's clear up something as well. Because the Fed increases the Fed funds rate doesn't really have a direct effect on mortgage-backed securities, which is mortgage rates, right?
Okay.
It has a trickle-down effect. It's factored in, right? So with what the Fed is doing, as soon as he starts to ease, I foresee rates coming down slightly, maybe towards year end. So let's say if we're at 6.25 now, maybe you'll see high 5s. I don't think there's going to be any drastic change, not until next summer. Okay.
And then what do you think the change will be?
I don't ever think you're going to see rates at 3% again. I think the new normal will probably be around 4.5%. That would be my guess. But like I said,
manageable, right?
I have no crystal ball. And let me preface something else. This advice, I am not a CPA. Anything that I disclose today, please check with your CPA, right? So
we can check.
Yeah.
So you don't think that it's going to come down anytime soon? In terms of next year, then you said summer. What indicators do you see
I think
happening
as soon as the Fed gets this inflation situation taken care of, I think you will slowly going to see a decrease in mortgage rates, right? So I do foresee maybe by next summer, maybe rates in the mid-falls. But I think that will be the new base. I don't think you're ever going to see 3% mortgage rates again.
Yeah, I think that will stimulate more activity in the market because.
Well, I think as soon as the uncertainty leaves the market, I think that's when things will settle down, right? I think a lot of people are on the fence. They don't know what's going to happen with property values. They don't know what's going to happen with interest rates. And quite frankly, if you have a home and you're paying a 3% interest rate now, why would you sell it?
Yeah, there's no reason
right?
to. Because
it would be literally a backwards move because you'd be paying now 6% on a rate. And the property value you'd be paying for would be, inflated as well. So it would make no sense to me. But look, my phone rings all day long with these questions, right? So the biggest question are with adjustable rate mortgages, which, as I said, as we've discussed, it just makes no sense to me why somebody would want to spend more money on an adjustable rate when they can have a 30-year fixed for less money, right?
Yeah, it doesn't get me. But so what would be going through the mind of someone who wants to do that?
I think they don't grasp what I'm actually saying to them. They can't understand how a 5-year adjustable rate is more expensive than the 30-year, right? And they're saying, well, so is this 30-year an adjustable rate? I said, no, this is a fixed rate, right? Versus an adjustable where it's going to adjust off the 5 years.
And let's just break that down really simply so people understand it. So my understanding is a variable rate can change and a fixed rate will be the same amount of cash payment every month for the next 30 years.
That is correct. And at the end of the 30 years, you've paid off the loan in its entirety, right?
Yeah.
So with an adjustable rate mortgage, you have a fixed term, whether it be 3, 5, 7, or 10 years, right? After that term, it will then go to something, it would be adjusted to the margin and the index that loan was originally attached to. But it becomes rather it being an interest-only loan, it then becomes a principal and interest loan for the remainder, and it will adjust every year to a new rate. That's correct.
So the variable rate changes yearly until the end of the term.
That is correct.
Whereas the fixed rate...
Well, no, let's clarify. If it's a 5-year adjustable, it will be fixed for 5 years.
Okay, so let's just put some numbers around it just for context. So if we've got a variable loan for, let's just say, 6%,
right,
locked in for 5 years.
Right.
That means for the first 5 years, it's only going to be 6%.
That is correct.
But after those 5 years, it will vary year to year based on market conditions.
That is correct. And most of them have a cap rate of 5% over the initial rate. So if you're paying 6% for the 5 years, the maximum that loan could go to would be 11%.
So it's ridiculous.
Well, it's huge. Well, of course, right? I mean, absolutely. You're going from 6% to 11%. Now, that won't happen right away, but it will max out at that 11% cap.
So what percentage, I don't know if this is public information or not, of loans are currently fixed versus variable?
Yeah, I can't tell you.
Yeah, you wouldn't know.
I wouldn't know.
But I would say the vast majority has got to be fixed.
Well, 100% of all that I do are fixed rates because I talk clients out of adjustable rate mortgages all the time. The only time, that an adjustable rate mortgage makes sense is if you've got an exit plan in 2 years. Lee, I'm buying this place for a couple of years while I'm building this home there. I'm going to sell it in 2 years. Then it would make sense. Well, not in this market because the 30-year fixed is less expensive than adjustable anyway.
So one thing is the expense. Is it easier to get a variable rate versus fixed?
It makes no difference. It's just a loan program. The qualification is exactly the same. It makes no difference.
I'm finding it very difficult to understand why anyone would do it. Okay.
So I will tell you a great loan, and you mentioned it briefly, the reverse mortgage.
Okay.
There is a lot of misconception about reverse mortgage as well, that these people lose the property.
But you've got to be over 62.
You have to be 62, that's correct. But it's a wonderful product for those certain people that are equity rich and have no cash to live on, right? Or have minimal money to live on. House is worth $5 million, it's owned free and clear. We can get them a couple $1 million. Let it sit in the bank, live on that money. Yeah. The loan gets repaid, when they pass away or, sell the home.
Bit of extra comfort.
Yeah. And they don't use tax returns. I mean, they will look at tax returns, but they don't use them as qualifying. It's a very simple loan.
And that's more for elderly people with a low income that have got, like you said, equity rich, cash poor.
Exactly. Much. Yeah. Perfect. And it's a wonderful loan.
So let's just go through the final thoughts as we look to wrap up. To summarize, to get that qualified loan, what was the name of the loan? The main one that people don't qualify for? The QM loan?
For the QM loan, for the qualified mortgage. So anytime that you don't use 2 years tax returns and 2 months bank statements, it's considered a non-QM.
Okay, so it's QM versus
non-QM. That's correct.
QM is mainly for employees that have been in this, let's
W-2
say
salaried employees. Yes, very cookie cutter, simple. You have 2 years tax returns, 2 months bank statements, a recent pay stub, covering the 30-day pay period, right?
But the majority of people are doing the non-QM loans.
90% of my clients, especially the ones set up with trust that are showing very little as far as income coming through their personal statements, are using non-QM. That's correct.
And even though it's a slightly higher rate, we can't compare the rate of the QM versus the non-QM because the tax savings in the non-QM far surpass the small increase that you'd pay with a higher rate.
This is exactly right. And one other misconception I would like to clear up. Paying points to buy down the loan versus not paying points.
Okay.
Everybody out there is asking for a 0-point loan because they don't understand what buying the rate down means, right? With purchase money loans, that is the only time you are able to 100% tax deduct the points that you are paying down to buy the rate down. You can't do that on a refinance loan.
Okay.
So why not take advantage of paying points to buy down the rate when it's 100% tax deductible? Doesn't that make sense? If the rate was 7% and you could buy it down for 1 point to 6.5, or buy it down to 6% at 2 points.
How much would that cost to change?
It's 1 point is the loan amount, right? So if it's $1 million loan, it would cost you $10,000 for 1 point.
Okay.
Right. But that is tax deductible. That's written off the top.
That's tax deductible if it's owned in an LLC.
Oh, no, it's tax deductible
personal?
only when it's a purchase money loan.
Okay, so it's got to be a certain specific set.
It has to be purchase money. It can't be a refinance of a loan, right? If you were to pay points to buy down the loan on a refinance, that's not tax deductible.
Got it. Okay.
But on purchase money, it is.
Perfect. Yeah, so it's good to understand the difference. And why don't more people do that then?
Because they don't understand. They think it's just a fee. They don't understand what they're benefiting by paying the points.
In our business, on the tax saving side, we call it being proactive versus reactive. This is exactly the same in the mortgage broker business, right? It's like, if you have that little bit of excess cash flow right now, you're better off prepaying this, getting it down, taking the tax deduction, being proactive rather than being reactive and overpaying for the next 30 odd years.
Exactly. That's right.
So
take advantage of the buy down, right?
Yeah. See, that's never even been mentioned to me in all the real estate that I purchase. So that's interesting to know. So Lee, as we wrap up, what is the best way for people to reach out to you?
Well, they can contact me at my office. The phone number is 866-998-9698. Or they can simply go to my website, which is integrityfirstmortgagesolutions.com. I'm available 7 days a week, so have them reach out. I'd love to speak with them.
Perfect. So we'll put Lee's details right below here so you can just click a button and get in contact with him. Stay tuned and stick around for the next one.